So let's look at. So the last point we discussed the other day, what we were looking at, if we look at your notes, right? Last point we discussed was we were trying to look at the how the project. We are trying to fit the whole project NPV scheme into the buy-sell paradigm. Remember that? So we were trying to say that everything in that left box, everything on the left-hand side in the value, we'll just call, instead of using such a big word, a big expression like value versus price comparison-based analysis, we will just say value versus price. In the value versus price world, the basic framework, okay, is if market price is above fair value, then you sell it. If it's below fair value, then you buy it. So how does that work in the case of the project? What we were discussing yesterday is, was it in this one? We just have to find the notes. The notes are a little bit all over the place. I will consolidate them. I'm in the process of consolidating. I'll make very soon you'll have a consolidated note where you can study everything about models. Okay, I've added one more point here to all those improper uses of the word arbitrage. Okay, remember we discussed CRA. So you should have a very clear understanding in your mind of what is CRA. It must be a transaction where all market risk is removed and everything is instantaneously locked in. Okay, market risk must be completely removed, and so there's another. And so all these terms that are used in the industry, you can see so many terms that are used using the word arbitrage, and I don't even think I've covered everything. Okay, I've added one more term, which is statistical arbitrage. That is also actually not CRA. Okay, although they use the word, I'll explain what later on I'll explain what stat arb is. It's basically looking at historical relationships. So essentially in stat arb, what you would do is look at historical relationships. Okay, I'll just explain this briefly here. Where's our? If we can find. I'll just briefly explain stat arb. It's still on the subject of models, so we're just deviating a little bit from what we discussed the other day, but in between the discussion of the NPV framework and how it fits into the buy-sell, the NPV model and how it fits into the buy-sell paradigm. Okay, so let's do one thing. Let's make this a chart of GM. Okay, I think the GM, everybody understands GM, General Motors. Okay, very big car company. Okay, and then we are going to do a comparison between, compare or add, let's call it Ford Motor. Okay, so let's compare GM and Ford. Now you understood what I'm trying to do. It's like comparing Maruti and who else car company that we have in India? Hyundai. Yeah, if we have the stock of Hyundai listed in India. Okay, so then we compare Maruti versus Hyundai. So similarly we are comparing Ford versus General Motors. Okay, so this is General Motors. You can see the dramatic discrepancy in the price performance. Okay, that this is up and this is down. Can you see how much difference there is? This ad business is coming again. Okay, you can see now these are actually both car companies and reasonably big car companies, so they are comparable. You're not comparing a small company with a big company. So what essentially was the philosophy behind statistical arbitrage is basically, why is it called statistical? Because this is once again another improper use of the word arbitrage. So where do we have it? Yeah, so essentially buy sell assets when they are out of line with each other relative to data, let's say historical. That's where the statistical part comes in. This historical data is where the statistical part comes in. So essentially the philosophy, try to understand the philosophy here. What the philosophy behind statistical arbitrage is that you take a couple of assets which are related. Okay, so here I should put in another word here, which is that buy sell to related assets. Okay, so it's not like I'm comparing Apple to Ford Motor. Okay, I'm comparing General Motors to Ford Motor. So my theory is that since these are both global car companies, their performance should have some broad similarity, because if there's any trend in the auto industry, it should affect both of them equally and all that. So you take the basic idea, you take some two related assets, but related doesn't mean that they're identical. Okay, they're obviously two different companies, so there are certain, you remember in your CAPM you did the idea of systematic risk and non-systematic risk. Okay, so every company has some idiosyncratic risk. Okay, so that will cause some differences in the share prices, but they're also not going to be they're not going to be too far out of line, should not be, because the same industry. Okay, so what you do then is, this is just 4 hours of data. You can actually take much longer data. They usually will take many years of data, and what they will do is they'll look at you can see here, again here also there's a lot of difference. Okay, that Ford is generally underperforming. Okay, so here what they'll do, they'll take many years of data for two related assets, and they will look at the historical relationship between these two assets. So they'll maybe come out, in this case there's quite a large discrepancy, but they actually might say, can you see here that for a while it was moving all together closely? Okay, so and now the prices have started to diverge. Okay, prices have started to diverge. Now the performance since late 2016 has started to diverge. Ford Motor has gone much lower, and this has done relatively better. Okay, so now the idea behind statistical arbitrage is that the guy will look at it now here in this kind of a situation and say, look, for so many years we had such a close relationship, and now these prices have gone out of line with each other. This situation can't be sustained. Okay, so they're basically going to insist that the historical relationship will have to be maintained. Okay, so so that is the basic understand the thinking behind it, that you take two related assets, you take a lot of historical data, and you see how the historical pattern is. Okay, this may not be a very good example, but because there's equal amounts of time diverging and being together, but you get the idea, right? So they would typically look at this part of it and say, historically they have been so closely related, but now they have gone far out of line with each other. Okay, so therefore the idea is, once again, the idea of convergence. Okay, these are also called, sometimes these are also called, that's why these are also called convergence trades. Okay, these statistical arbitrage trades are also called convergence trades. Okay, so this idea of you remember yesterday I gave you the example of this fund called LTCM, long-term capital management, which went bust during the Asian financial crisis and the Russian default. So LTCM was actually doing this kind of activity. Okay, essentially they were doing this kind of convergence. So convergence trades, convergence arbitrage, sometimes they call it convergence arbitrage, or sometimes they call it convergence trades. Understand why it's convergence and why it's statistical. Convergence means this is a convergence trade. So what will the guy do now? Can you guess based on what I told you? So the guy who believes in stat arb, who's the statistical arbitrage for short is referred to as stat arb. Okay, so now the guy who is a stat arb trader, what is he going to do here when he sees this situation? If he believes that this is the true reality, if he believes that this is the true relationship, that the two prices have to now converge, so what will he do? What trade will he do? By now you should have understood what is the basic framework of arbitrage. Buy Ford and sell GM. Very good. Okay, so you have understood the idea behind arbitrage, that you see that these things have fallen so far out of line with the historical norm, and that's where the statistical part comes in. You do your analysis of standard deviation for many years, and you see that it has now gone 3 standard deviations beyond or 4 standard deviations. You have some limit. So you say, if it goes beyond 4 SD or 5 SD, then I will jump in, because it can't stay beyond like that, beyond 5 SD for so long, for too long. So eventually it has to come back together. Okay, so are you following this logic here? Okay, so they're essentially saying that this is also a fair value based kind of thinking, because you're saying that the fair value of the difference between these two is somewhere like what we used to see over here. and now the fair value has become too wide. The market price of the difference has become too wide. So this market price has to converge to the fair value and become much less. Is everyone clear? So in a situation like this, they would be buying Ford and selling GM. The idea here is that eventually the two have to converge. Okay, because that historical norm has to prevail. So now you understand why it's also called statistical arbitrage. Okay, because the statistical comes from this part, that the analysis of all this SD analysis and all that you do here. Okay, many funds are doing this actually. There is a very famous fund called Renaissance Technologies, which is one of the most successful hedge funds. What they do is basically a variety of this, but they do it in a very diversified way across many markets. Okay, with different strategies, different norms. One model might be doing it if 3 SD is crossed. One model might be doing it if 6 SD is crossed. Okay, so they have a lot of diversification built in, but the basic idea is a lot of statistical arbitrage. So if you hear stat arb, this is what basically the thinking. It can be applied to various asset classes, various markets and instruments. Okay, but the thinking is always like this, behind statistical arbitrage or convergence trading. Okay, this is the idea. So once again, you can see that. Can you see why it's not CRA? Because if I buy Ford and sell GM, there's no guarantee. I'm not locking in any price. I still have to wait for the thing to happen, for the convergence to happen, which God knows if it will happen or not. Okay, it's the same as somebody who buys Ford thinking that wow, Ford has fallen so far, it looks really undervalued and underpriced relative to fair value. The same thing, it's still a risky trade because you don't know what the market is going to do. There's no way to force the market to come to your fair value because there's no CRA kind of setting. Okay, is this clear? So another term that you learned, another strategy, okay, that you've learned. So this can also be a module for some of these people have gone for interviews, Shuchi and Anjum.
Yes.
Okay, the interview is not on campus.
No, sir.
Okay. So I guess they will be marked up present later. That's okay. That we'll take care of. So I was just telling them, Shuchi was asking yesterday what to study and all that. So I mean, I've already told you this before for your interviews, that you prepare into, obviously one is you read as widely as possible, follow the markets, and you try to anticipate the questions that come, right? But the other thing so there are two types of questions. Either you will get a out of the blue question, and that you can't really prepare for specifically, but then you also prepare. The second thing they might ask you is, so what have you studied? If you could not answer the first question, so tell me what have you studied? So here you should be ready with certain concepts which you have mastered thoroughly. So you can say we talked about arbitrage free valuation models. So in that we discuss classical riskless arbitrage. So we have also learned about the difference between what is CRA and what is not CRA. And you can give all these examples: merger arb, stat arb, vol arb. All these are actually called arb, but they are not actually CRA. So these are improper uses of the word arbitrage. So this can. So you have to think you understand modules.
Yes, sir.
Okay, everything is a module, right? So you can think in a modular way about topics, but then you have to master the topics. If you take option trading as one topic, then the whole in and out of option trading, you should be able to talk confidently about it, right? So this is how you should prepare. Okay. So this is another term that you have learned. Now with this we will just go back to our discussion yesterday with the NPV part. Okay, buy, sell two related assets when they're out of line. Now you understand, based on what I've explained and what I've written here, you should understand what it is. Okay, all right. So we go back to our discussion of the discussion we were having yesterday about So this being the market price of the project, what we discussed. Okay, so if you see here, you can just go through. I don't want to spend too much more time on this. Where is the calc file? Yeah. So the basic idea here is that, okay, so we'll make this 90. So, all right. Okay. So the idea is here, if you see again in the case of in the case of the project, what you're comparing is, where did I have that? So you're comparing the fair value of the project to the, now I've lost that NPV chart. But anyway, you understand the concept of NPV already, so we'll just leave it there. Okay, so you're comparing, so in the NPV equation, you have that minus C0 term, okay, and that minus C0 is essentially like the market price. So when the NPV is positive, it means essentially that, so that equation can be rewritten as fair value minus market price, right? So when the fair value is minus market price is positive, okay, then it is positive NPV, and that's when you are actually buying it. You're accepting the project. It's like buying the project, okay? And when you reject the project, it's like selling the project in a situation where you can't sell, but at least you don't buy, right? Okay, so we can actually show that you can actually, it's just like selling the project, okay? So if you do this for any of these things, you'll see that essentially it's the same, this framework applies. This framework that we have given you here, okay, which is that this concept of this general framework, which applies to everything over here on this side, okay, that this can be applied, that this, all these fit the framework, okay, that all of these are essentially our fair value methods, okay? So when you do bonds also, when you discount the cash flows of the bond, you get the fair value of the bond, and if the market price is less than the fair value, then you buy, otherwise you sell, right? Same framework. Same for stocks. The formula directly gives you, like a Gordon growth model gives you the fair value of the bond, of the stock, okay? So this we have already done. Now what we have to test is the other point. Is this clear so far to everyone? Yeah? So we'll go on to the, now we go back to your question, okay? Remember I asked you a question, okay? So we are applying this by this framework to all the asset valuation models, okay, which we have, the forecast based asset valuation models which we discussed right now, okay? Now what are we now, where do I need to find that? Okay, now we come to your question. You remember your question that I asked you? What is the difference between project IRR and bond NPV? Bond YTM and project IRR. Anybody has the answer to that? Yes? Anybody has an answer on this point? Okay, so I'm showing you both of those, okay? Both of you, everyone can see this? Others, you can also read the writing. Maybe the stuff is a little bit small. Now you can see. You can even make it, and you can see where 11 is. Where is F11? Where is my F11? I can't even see my F11. That I know, but where is my F10? I can't even see it. Okay, alright, now it's hopefully a little bit better. So now we are discussing this important point, okay? Nobody has the answer to this? The question is very simple. What is the mathematical difference in mathematical terms, okay? What is the difference between project IRR and bond YTM? Is the question clear?
Yes, sir.
Okay, so this is your answer. I will put all this into your notes. Everything will be there in a consolidated note within 1 or 2 days. Okay, but I think now this Zoom is too big to allow others to see. I made it too big. Then now, okay, so now you can see everything.
Yes, sir.
Okay, this is your NPV equation. This is your IRR equation. Okay, this all we are doing in this IRR is basically we are moving this to this side, because CFO anyway has a CF0 has a negative sign. Okay, so it's a CF. All we are doing in the IRR equation is that we are moving this to this side. Yes, correct.
Yes.
And we are repeatedly doing trial and error to find out such an IRR which makes the right hand RHS equal to the LHS. Yes. Okay, that's your project IRR, that you know. Okay, now bond YTM. You remember the equation of the bond YTM also? You can see it on the lower side. Yes, everybody can see. Bond YTM, you remember this? LHS is bond price.
Yes, sir.
You remember this? Shreya is not able to recognize bond YTM.
Output is YTM. Output is
Yes. Output is YTM. Okay, that I could have asked you again as a question, but you already answered it before the question was asked. It is YTM. So Pulkit has already given us the right answer, that mathematically there is no difference between bond YTM and project IRR. Okay, now let's understand why that answer is correct. Yes, Khushbu, you're not feeling well.
Yeah.
So then why did you go home? So whatever rule I made, that rule is there are medical. If I feel anybody is not feeling well, if I see somebody is not feeling well, or if somebody says I'm not feeling well, and then you go home now.
No, I just do it like that.
You're sure? Okay. All right. So okay, guys, please concentrate. Parul. Concentrate. Have you understood Pulkit's answer?
Yes.
Sir, how can they be the same?
Okay, mathematically. I said mathematically, not conceptually. What is the question? Mathematical terms. In mathematical terms, why are they the same? Okay, so why has Pulkit answered the same? Now let Pulkit give the explanation. Give him the mic. Give the explanation. Now your answer is correct. That in mathematical terms there is no difference. Now you explain your answer to to Chuk. And
So I think we have just taken the variable, name of the variable. But the formula is
okay, let's start with the LHS. In the LHS,
in bond YTM formula we have bond price. In that higher formula we have initial investment.
yeah, project cost,
Project cost.
which we have already shown is equal to the market price of the project. Yes, correct. So we have shown that the project cost is equal to the market price of the project, effectively like that, because for the guy who is evaluating the project, that's what he has to pay to buy the project. Okay, you can imagine an already constructed line that you are buying instead of constructing the line. Okay, so therefore it's the same. So the LHS is the same conceptually, because in both cases you are looking at the price of the asset, the market price of the asset. So in both cases LHS is equal to the market price of the asset. Yes, Shivam, you're following? Okay, both cases is equal to the market price of the asset. All right. So now, Ritesh, you are also not feeling well. Then go home. Don't wait. Don't take a for it. Whatever rules they don't apply in case of medical emergency. If anybody is not feeling well, if I feel they don't, of course, I mean this is only for it should not be abused. This privilege also should not be abused. But I can usually make out by looking at people's faces when they are not feeling well. Yes, Parul, you also want to become. Yeah. Okay. Khushbu, you can also leave whenever you want. Okay. All right, guys. Let's cement this understanding clearly. Make sure that you understand. This is all important for your conceptual understanding. You were not clear about this earlier, right?
Yes, sir.
So it's all important for your all. We are covering the same basic stuff you've done earlier, but we are making sure that your understanding is 360 degrees. Everything is clear conceptually. Conceptual understanding is very important. Okay. All right. So the left-hand side, Pulkit has already shown that left-hand side both are the same thing. We just have different names for it. Okay. One is the market price of the second. Now let's look at the RHS. Let's look at the numerators on the RHS. Can we say that the numerators on the RHS are all returns? Returns from the, what is the problem, Parul? What is the problem? You want to go that side? Okay. Okay, so the numerator on the RHS, the numerators on the RHS, can we generalize them by saying that they are both returns? Both of the numerators on the RHS are both periodic returns. Yes, correct. Puneet, you agree? Okay, both are periodic returns of the same of the asset. Of the in general forms we write this expression, then it is the periodic returns of the asset, both of them. Okay, then in the numerator we have the same mathematical expression, 1 plus R. Now that R may be a IRR or it may be a YTM, but the numerators also, the denominator also is the same. All the periodic denominators are the same, except the powers are also the same. Okay, yes, everyone agrees, right? So now you can see that mathematical terms, this also you should have this understanding to complete your understanding of models, conceptual understanding, that there is no mathematical difference between the bond YTM and the project IRR. Okay, because all of you can take it stepwise, that everything is the same. Basically, left hand side is equal to market price of asset, RHS numerator is equal to returns from asset, RHS denominators are equal to discount factor. In general terms, we can call it a discount factor. What is what?
What is P?
P. P is the principal.
But it is not in the uniform.
No, see, basically this is there is. Okay, good question, very good question. Okay, very observant. Also notice that this should have been written as one term, because you see the power here is the same. The power here is the same, right? So this is bullet repayment of principal. So this could have been written as Cn plus P. Okay, so it would not show as two terms. So this is how many times we write it like that, CN plus P. Okay, so it's the same last period payment. Okay, so Parul has raised a very good question, which is they are not the same. So she is protesting that they are not the same because it's a very good point. Now I may have to go out. Okay, I'll write it down later on, but let me first explain it because I don't want to get out of this F11 view, full screen view. Okay, the answer in project analysis, do you remember something called salvage value? Right?
Yes,
So the salvage value is what? Is what you get by selling the plant at the end of the project. Okay, so can we call salvage value in general terms? Can we say like the disposal value of the asset, the terminal value of the asset? Okay, terminal asset value. Yes, can we say that? Okay, now is the principal of the bond, can we call it the terminal asset value?
Yes.
Because both are inflows. In the case of salvage value, you sell the project at the end of the period and you sell the plant and you get some money. And in the case of the bond also, you return the bond certificate and the issuer of the bond gives you the final principal payment. Yes? Clear? Okay. So they are the same now. You can see that in the project analysis, typically you will have some kind of, maybe not always, but in general terms you can write salvage value. Okay, so therefore this can be like a but in most cases you will have some kind of value that can be realized by selling the project, by the plant and all the other.
So in project IRR, what is the thing that we're getting in, what is the salvage value?
No, see, what will happen is typically, see, if you take this format, which is the more general format, okay, since we are anyway saying that mathematically they are identical, okay, because anyway we know that there's general asset valuation framework, okay, so mathematically these are identical, they are flowing from the NPV equation, you can think of it that way. Now, if you take this way of writing the last term, if you combine these two because the power is the same, okay, and if you take Cn plus P by this, okay, as the last term, and if you take this as the general framework or the general form of this writing the last term, then if you take this term once again and then rewrite it in this general form, if you rewrite it in this general form, this CFN, okay, if you want to keep it identical with the nature of the other cash flows in the previous periods, this let it be the return, the kind of a revenue return from the project, like revenue from operations, okay, but this CFN should be added, there should be another term in the numerator, the CFN plus SV, salvage value, then that will have the same form as this. Are you following what I'm saying? At the end of the period you have some revenue returns, so we want to distinguish the revenue returns from the capital receipts. Remember we did a case, a revenue receipt versus capital receipt.
Yes.
In income tax law we have this important consideration. So in income tax law, what kind of expense is deductible for the purposes of computing taxable income? Revenue expense or capital expense? Revenue expense is deductible, capital expense is not deductible, which is why in many income tax cases the litigation involves the question of centers around the question of whether a certain expense is a revenue expense or a capital expense. Okay, remember we did that case called Empire Jute Mills, okay, which is quite a landmark case in Indian income tax litigation. Okay, so where, if you remember, Rajan also raised this important point on the linguistic point, which is the use of the word expense versus expenditure, whether they are the same thing. Okay, that actually the correct use of the word should be expense, not expenditure, because expenditure involves basically outflow of cash, but it need not be a P&L debit in that period. If you go back to our discussion of that time, okay, remember this you should know also as an accounting matter, right? It's all there in your lab notes. If you go back to your lab notes, Rajan asked this question when we were doing this case, okay? Because in many of these income tax cases, the judges who are not trained as accountants, okay, they keep writing expenditure, revenue expenditure, but actually that is not correct, okay? The correct use of the word is, the correct expression should be expense, because you're always talking about the tax P&L. You're talking about the computation of the tax P&L, okay? So what goes into P&L, not necessarily expenditure. You may have an expenditure which does not show as an expense in that period. If you are capitalizing, you know what is capitalizing of expenditures? If say whatever, let's say Disney was planning to launch this Disney Plus service for the last 2 years, and they have been advertising for the last 2 years, trying to build up demand for the Disney Plus service. Okay, now if the Disney Plus service has not started operations, they should not expense, let's say they spend $10 million each year on marketing the Disney Plus service in 2017 and 2018. Okay, and they are only going to launch in 2019. So then 2017 and 2018, those $10 million each should not have gone to their P&L debit. They should not have shown as expenses in the P&L. Are you following? Because you have to match the ongoing operations to the expenses. You don't show the expenses until the actual business operation has commenced. Remember that? Yes? Are you following what we are saying?
Yes.
Matching concept, you understand? Okay? So we loosely say matching revenues to expenses, but actually the right way to state that principle is that the expense, if it relates to a particular kind of business operation, when the commencement of that business operation happens, only then you should start taking those expenses to the P&L. Are you following the logic? Okay, so it's not just loosely matching revenues to expenses, because there may not be any revenues. You may be just, but the business has started. Business has started, maybe you are giving 3 months free trial. If you are giving 3 months free trial, okay, there's no revenue because everybody is on free trial, but expenses are happening, and in this case you can deduct the expenses because the business operation has commenced. Are you following the discussion? Right? So 2017 and 18, they are building up demand for Disney Plus, advertising, spending $10 million each year, but they should not expense those $10 million costs in those 2 years, 17 and 18, because the business of Disney Plus is starting only in 2019. Yes, are you following? This is the proper application of the matching concept. Okay, so why did I come here? Expense, expenditure, capital expense, because we came here because we were discussing salvage value, and the right way to write this last term is CFN plus salvage value. Okay, in that case you're making a distinction between this revenue income, the revenue flow, okay, the revenue receipt here, the CFN is the revenue receipt from the business operations of the plant, okay, and the salvage value will be the capital receipt from the sale of the plant. Are you following what we are discussing? Yes? So from that point of distinction between revenue receipts and capital receipts, we went into income tax law, which is how you should study. You should always study everything from a multidisciplinary perspective. It helps, enriches your understanding, right? So then we went into that and we discussed this concept of what is deductible. So it's revenue, expenses are deductible. And then we went into the proper use of the word. So the word that should be used is expense, not expenditure, okay? And then we went into the distinction between expenditure and expense. Okay, so the classical distinction is that expenditure is only an outflow of cash. You can go back and read it again. I'm not going to spend too much time explaining it once again. It's there in your lab notes, which means it's there in the lab videos also, okay, for your class. So expenditure basically only means an outflow of cash. So those, let's say, go back to the Disney Plus example. In 2017 and 2018, they have spent $10 million each. So those advertisers have to be paid, Facebook has to be paid, Google has to be paid for the ads. So the cash is flowing out, okay? But those, the corresponding credit cash, corresponding debit is not to the P&L. It is not an expense that you're taking in those years. You're capitalizing that expense. So that later on when you start so by the time you start your operations in 2019, you have already capitalized $20 million of advertising expense. Are you following? So now when you have started your operations in 2018, now you will start debiting those expenses. Okay, you'll follow a system of some pro rata system, and then now you'll start debiting those expenses, and then you'll credit the debit balance you have built up in your capitalized advertising expenditure account. Are you following the logic? So everything is connected. You are connecting finance to income tax law, also to accounting entries, journal entries. I hope everybody is clear about journal entries. 100% clear. So when you are doing this initial 2017-18, okay, you are spending $10 million each. So you are crediting cash because you are paying cash to buy your Facebook ads. Yes, okay, and to buy your billboards wherever, okay, spending money on billboards. All the ad expenditures paying, let's say, coming in cash. You're crediting cash. Everyone is clear about that? And you are debiting, let's say, an account which you will call capitalized advertising expenditure account. Yes, so you'll build up a $20 million debit balance there. Then now comes 2019 when the business commences. Okay, so you will have other new expenses for 2019 itself, but you will follow some formula of maybe that capitalized amount I have to expense out over 2 years or 3 years. Usually there's some accounting rules also. Okay, let's say you have to do it in say some number of years. So you will follow, so every year, every month you will, or every year you will take, let's say 50% of it. Okay, you have to finish it in 2 years. Then the first year you will take in addition to whatever you are actually doing in 2019. In 2019 also you will be spending some money. Yes, so you'll be debiting that directly to the P&L as expenses, plus you will be debiting some of the historical expenses which are capitalized. So for that again the entry will be, you will debit P&L, advertising expense, and you will credit that as that balance account that you have built. That's a debit balance account. Are you following? Yes, capitalized advertising expenditure, that's a debit balance account, $20 million starting balance. So this 2019 you will take the hit of $10 million into the P&L. So you will debit 10 million here and you will credit 10 million there. So that balance will now come down by 10 million. Are you following now? Okay. So in this discussion itself, you have connected 3 different disciplines: finance, income tax law, and in accounting, to make sure that everything. So as an MBA student, this is what is required of you, that you should have total fluidity between all these different disciplines. You can't say, oh, I'm a finance student, I can't go to income tax law, so I can't do accounting. You are expected to do everything. Okay, you should be able to cover all the domains. Okay, and then if there is a marketing angle to this, maybe they should have started marketing in 2015 according to you, whatever. So there's a marketing angle to that, that also you have to bring in. Okay, so you have to be able to connect. That's what people expect from MBAs. Okay, because you're not a hardcore programmer or something. Okay, so you have to bring a certain different skill set to the table. The skill set you're bringing to the table, among other things, communication skills, office productivity software, all that stuff. Okay, very tech savvy. The other skill that you're bringing, the most important skill that you're bringing to the table, the most important skill is this ability to integrate different domains of business into a business, any given business situation. This is clear? Any analysis? This is what you have to work on when you want to polish your skills as an MBA student. Yes? Everybody's following? Okay. Alright. So, Parul, so is your question about salvage value satisfactorily answered? Yeah? So we will write it ideally as a last term, CFN plus salvage value in the end. That equates the 2 equations, that equates the 2 expressions. Okay, that they are identical actually, conceptually they are the same. Okay, so that finishes our other topic.
So,
yeah.
you can also say that they are same mathematically, as in both of them we use different trial method.
Yes, you can say that also. From a computational point of view, both. Don't say hit and trial. Don't say hit and trial method. Some people have written that. You can say trial and error is slightly better than hit and trial. Okay, because the hit is also a trial. So the correct expression is to say, I have written it in your notes, iterative approximation. Okay, so when you do these kind of things like moving the left minus term CF0 to the left hand side, these are called analytic solutions. Things that you can solve by doing this, those are called analytic solutions. So the correct mathematical expression is iterative approximation. Okay, that you iteration, you understand? One run, second run, third run. Okay, in IT you have this concept of first pass. When you're testing memory, if you run a mem test, you'll see that the mem test, the system does a first pass, then it does second pass, third pass, it keeps on. The pass is an iteration. Okay, so iterative approximation is the expression that you should use, because remember, another thing that you're expected to do as an MBA is to use sophisticated language, proper language, not like a layman's language like hit and trial. You have to use the correct technical terms. Okay, so that's the point of being an MBA, right? That you have already been trained in a business school. Okay, so we have understood this concept now of okay, so we are here. We were going to cover this point, right? Project IRR versus bond YTM. Now, what happened? This is hanging a little bit. No, this is actually the wrong one here. Okay, so we have done this more or less. Okay, so everything is now covered. Okay, now I think we are ready to move to your. Let me just check if I have any other topic to cover. Examples of I think we have made it pretty much done. So now I'm going to move on to your now we'll move on to your case. Actually, for futures also we have covered, okay, because I want to start your case because I'm a little bit worried about how much time we are going to have. So we have a class tomorrow as well. In the morning, right? So relentless for you guys. So I harass you in the evening, and then as soon as you come to college, I harass you again. Okay, this is like a teacher harassment, new kind of disease. Okay, okay. So what we are going to do is we'll try and have a discussion in the next class, in the class tomorrow. But we'll open this. So what you guys should already start doing is, because we are going to be on a very tight schedule because of these very tight quadrimesters, not even 2 months properly. It's very difficult to do these projects in a satisfactory way, but we'll make the best of whatever, as something is better than nothing. So we at least will get a flavor of things and we'll learn something along the way. Okay, so remember all these contracts needed for the project. I have put the euro-dollar futures contract. Okay, this is the interest rate futures contract. This is not in bold because this is not being going to be actually used in the project, although it is part of the case discussion. Okay, so these other projects, you better these other contracts, you better make yourself familiar with these futures contracts. Okay, and already start trading. In your thing here, you can see that all these things are already there. The crude oil futures. Go to the quotes page, see which months are trading, make yourself aware of which are the ones with the high volume, which are the high volume months. Okay, because here also, just like options, you have another extra decision problem. Which contract should I trade? Because there are many different contracts trading at a point of time. Which month should I trade? Okay, so those things, make yourself familiar with all these contracts. Okay, gold, copper, Aussie, yen, crude oil. Okay, try to figure out how this yen, why is this yen price showing this? When you look at this dollar yen price here in this form, okay, and why is this yen futures contract? These are all against the US dollar. Okay, so only one is shown, but actually this is again the question that Rajan asked. There's only one contract. Okay, that it's actually, again, obviously there have to be two assets in any given market. So the asset that is not stated is the US dollar. Okay, so this Aussie, if we put an Aussie quote here, you can see this is familiar. This is a standard as the quote, the same way the spot Aussie is quoted. But here, can you see a difference between the dollar yen spot and the yen futures contract? Can you see a difference? Yes. Why do you think this difference is arising?
The base asset and term asset have interchanged.
Yes, so base asset and terms asset have been interchanged. In the futures contract, the CME Globex yen futures, okay, the yen has been made into a base asset. Okay, so you have to look at the contract size and all that. So your case has been structured in such a way that it is around, your total exposure is a round multiple of the CME on the currency side, and also on the commodity side, the exposures are round multiples of the CME contract sizes. So that when you trade using CME contracts, if necessary, you can go to 100% hedged. Okay, so we'll see all those situations. Okay, so make the point I'm trying to emphasize here is we have very little time. Okay, because I have to cover all these. I have to cover all the theoretical foundation for your project to help you to do it. So it will be always less than satisfactory as an experience because of the tight schedule that we face. Okay, ideally I would teach you all the theory first and then do the project, but we don't have that luxury. Okay, so you have to understand that. Okay, so do your best to understand all these futures contracts inside out. Refer to the book, the futures chapter. Okay, understand the contract inside out. All right, so now let's go and start the case discussion. Okay, so let's get you familiar with the case that we have. Okay, anything else in futures that we wanted to talk about? Physical delivery, all this stuff we already covered. Open interest, but it's okay. Open interest I'll discuss later. It's not a critical point at this. I don't want to delay the case discussion because I need to start the project. So we're going to go straight to the case discussion. Okay, futures, then case and project discussion. So we can close this now. Okay, so let's go bond YTM versus project IRR. Okay, here now I'm going to write down, okay, I'm going to write down the point that Parul raised, bond principal. So I'm going to just write this here to remind you guys is equal to project salvage value. Okay, this will remind you of the discussion that bond principal is equal to project salvage value. Okay, now we go to our next topic, which is case. Okay, all right, now let's understand this case. Try to so again, I'll put this into your notes, but anyway, just get the feel of it. I'll just move this into your case. So this is our case. I'll just give you a feel for this instead of making you read the notes. Okay, this is going to be the thing that you're going to analyze. Okay, this is actually a case that I have prepared as a general case to cover all the problems in corporate treasury risk management. So let's understand the problems first, okay, and then we will go into the theoretical foundations that you need to solve these problems. But so the right way to do it is first read the case and understand, try to get a flavor of the problems. You will not understand everything, but try to get a flavor of it. Then go back and read the theoretical foundations, okay, which will be given to you as technical notes. Read the technical notes and then again come back and try to solve the problems. Okay, so let me just explain the balance sheet first. Okay, so this is the balance sheet of this company, which is basically a natural resources company. Okay, and you can see, so it's a stylized, the first thing is it's a stylized balance sheet. You know what a stylized balance sheet is? A stylized balance sheet means it's not a full balance sheet. It's not a typical reporting, regulatory reporting balance sheet which you have, okay, where you have to follow the accounting standards, all the items are listed. Okay, it's not a full balance sheet for reporting purposes. A stylized balance sheet means I have taken, it's like an abstraction of a balance sheet. So I have taken certain key factors out. It has the general properties of a balance sheet, like assets and liabilities have to equal, okay, and the items that I've shown are not some, funny stuff which doesn't appear on a balance sheet. It has some stuff which appears on a balance sheet, but it is only stylized, and I have taken certain highlights of the balance sheet. Okay, it's not a full form balance sheet, like I've not shown the fixed assets. Okay, so it's a artificial kind of balance sheet where I'm showing total assets does not include any fixed assets, which is very unnatural, but for the sake of our discussion I have tried to keep the fixed assets out. Okay, so that's what it means to say that it's a stylized. So when you say, if you see the balance sheet and you think what kind of balance sheet is this, there's no fixed assets. Okay, because it's been done on purpose to include only what is required for the purposes of our discussion and for the purposes of understanding the basic principles of corporate treasury risk management. Okay, now we are talking about a different kind of problem. In the first two projects you have done this kind of stuff, buying and selling as a speculator. You have functioned as a speculator in your first two projects, okay, because your goal was, you started with $1 million, okay, in cash. Okay, so you had no risk on your book. Okay, and then you started with that, and then your goal was to increase risk to make money. So remember the definition of speculator: first transaction will increase your total risk. Okay, so your increased total risk had to increase with the first transaction. You'll be buying something or selling something. Okay, so in both the first two projects you function as a speculator. Now in this project you will function as a hedger, so which means you'll see that your total risk will have to reduce in your first transaction. You cannot increase under the golden rules of hedging, okay, which you will be introduced to. You will not be allowed to increase risk, so you have to remain true to the profile of the hedger. So your first transaction, so there will be a marked difference in the approach. Okay, so but make yourself familiar and also draw up the charts for all these markets, because you'll have to trade them. So please make yourself familiar. How am I going to trade? Start forming views on the assets. Okay, look at the oil chart and start forming views. Is it going up or going down? Practice and see what happens. Form a view and then see if you're right. Okay, so let's look at this balance sheet once again. Is everyone on board so far? Are you following? Okay, now we're going to follow. So this whole things, this is a case which is we will look at the spreadsheet, we'll look at the case problem, we'll read the technical notes, we'll have the discussion, plus at the end we will also, and while going on with the discussion, because we don't have much time, we will also start the project where you will be functioning as the treasurer of this company, managing this balance sheet, basically doing corporate treasury risk management. You will be in charge of that. Okay, so let's look at the balance sheet here. Okay, it's got three assets. Okay, you can see, I'm not going to read out everything. It's a natural resources company. So essentially what are the assets? The assets are just, and the numbers are also, you might think that this is a very small balance sheet, $6.7 million. Okay, the numbers have been kept artificially small because of various constraints, because we have only $1 million of equity. IB has given us only $1 million of equity. So if I have a massive balance sheet, Okay, ideally in a natural resources company, your balance sheet will be, even your inventory positions will be in billions of dollars. Okay, but if I have such a big balance sheet, then I try to hedge the whole thing. $1 million of cash in my trading account is not enough to do that job. Okay, so in order to keep it within the realms of the $1 million limit imposed by IB, okay, that's why I have made this such a small balance sheet. Okay, because you have to put up margin, then prices may move, then you'll have to put up more margin. So you must have enough money to cover your losses as well as your initial margin deposits. So because of all that, so that's another thing that you might notice, that it doesn't have stuff like fixed assets, and the balance sheet size is also very small. The size does not matter because your thinking process is not going to change. Whatever thinking process you learn in this balance sheet by using this balance sheet, it will not change in any way. Okay, when you manage a multi-billion-dollar balance sheet, the thinking process remains exactly the same. Is that clear to everyone? Just like when you have done US equity option trading, you have been taught certain theoretical concepts like how to, what kind of options to sell if you're on the selling side, that you should be in short dated options. Those theoretical principles will not change one bit if you are trading in Indian equity options. Nothing will change theoretically, okay? Your instruments will change, that's all. The actual underlying assets will change, okay? But nothing else will change. Theoretically, nothing changes. So the size of the balance sheet does not affect your learning. Yeah.
Sir, is just a query, sir. So those who are in mining business will have this kind of balance sheet.
Yeah, I mean, obviously it's a stylized balance sheet. They will also have, lots of fixed assets. Okay, they'll have other kinds of loans. I am severely restricted because I had to create a yen loan, I had to create an Aussie loan. Okay, and then because I am only playing with $6.7 million, so in that I have to create a reasonable yen loan, a reasonable Aussie loan. Then I have to create a dollar loan also, and you can see the size of the dollar loan is very small. Okay, this is all very artificial, but the point is that even the thinking process that you go through to manage a $100,000 dollar loan is exactly the same that you would to manage a $10 billion dollar loan. The thinking process does not change. I had to put in these small numbers because of the constraints of the IB account. There are only $1 million of money in each account. Okay. All right. People are falling asleep. Please stay awake. Okay. Please pay attention. We have a few more minutes. Make sure that you get the value from the class. Okay. Water bottles are not sufficiently filled. Please make sure you fill your water bottles sufficiently in the beginning before the class. Okay. If there is a water emergency, I can allow someone to go out, but you have to take all the water bottles. Yes, and you will be the Lakshman of the class. You'll go and get water for everybody. Okay? Is there any who will go? Verma will go. No. We'll send somebody reliable. Verma will go. You go and fill all the water bottles. Go and fill all the water bottles and come back quickly. Gil, also you can give your water bottle. Okay, now just concentrate for a while and we'll understand, we have to make headway because our time is very limited. Okay, all right, are you guys following so far? If you have any problem, any other water bottles? Okay, mining also you need a lot of water. So, okay, so the assets are basically, okay guys, now, no disturbance here, okay, concentrate. What has happened? What is Shrishti looking at? Concentrate on what is being discussed. Okay. Concentrate on what is being discussed. So the assets are basically just the current assets and only the inventories. We have not shown any cash also. Okay, very unusual balance sheet. So there's assets is only the inventory side. Okay, only the inventories of the material that they are mining. Okay, they're mining and sort of digging out from the ground. In the case of oil, we wouldn't say mining. Okay, we say exploration. Okay, so on the asset side. Okay, now these are actually these are the market prices. Okay, these are the market prices. Okay, this is per dollars per barrel. This is dollars and cents per pound, and this is also dollars and cents per pound in copper, and gold is troy ounce, and this is barrels. Okay, are you guys following? No. Be quiet and follow what is being discussed. Sharing food doesn't require you to talk. You just share as if you can't talk. Okay, so all right. Okay, Guys, now asset side is clear to everyone?
Yes, sir.
Okay. Now liability side, we have, it's not very pretty, the display is not very pretty, but you can understand it. So on the asset side we have 4 components. On the liability side. On the liability side we have 4 components, okay? At the high level we have 2 components. What will be the 2 components on the high level on any balance sheet? What are the 2 components on the, I mean, this is slightly American style terminology. So the 2 components is net worth and outside liabilities at a high level, okay? So net worth is the liabilities to the owners of the company. What in finance we say owners, in law we don't say owners, but in finance here, since we are discussing finance, we'll say we use the word owners. Or we can make it even more precise and say the net worth is basically the liabilities of the company to the shareholders of the company, okay? The equity shareholders of the company, the liabilities to the equity shareholders is the net worth, okay? Please follow here what is going on, okay? And the high level, 2-level categorization on the liability side is net worth and outside liabilities. Is this clear? All the debt is outside liabilities. Everything that is not debt, okay? Preference shares also we'll keep it as debt, okay? And everything else is basically liability. So reserves and surplus, everything is share capital, paid up share capital, reserves and surplus. Everything is contained under net worth. Okay, and so you have the high level split on the liability side, net worth and outside liabilities. In this case, outside liabilities are further split into 3 loans, one in yen, one in Aussie, and one in dollars. Okay, don't worry about the amounts, but just focus on the qualitative aspects. Okay, so we have 3 loans. The objective here is to introduce all kinds of risk, okay, which you will now subsequently manage through your project. Okay, so now, yeah.
So this was in the context of US balance sheet. In the context.
Yes, correct. Good question. Good question. Yeah. So this another point which you'll see, it's there in your case notes. I'm just explaining the case before making you read it. Okay. So this company is we can actually take that prompt to open the case and see. The main point, the point that Mayak has asked us, has basically led us to, is that this is a US dollar based company, which means essentially all their revenue. So in risk management, becomes one of the important things that you have to look at is asset liability mismatches. In the sense, your revenues are like your assets, because if you do assume in a simplistic scenario that all your sales are cash sales, all your sales are cash sales. Okay, and so if you sell everything very quickly and everything is in cash, okay, so your assets are basically almost tending to be all cash. Okay, and if you're doing all your sales revenue is in US dollars, okay, that means your assets are essentially in US dollars. Okay, although sales revenue is a flow concept, assets are a stock concept, but we are just converting this because we want to discuss the term asset liability mismatch. And the liabilities are whatever loans you have. Okay, so we don't, when we say liabilities, when we say asset liability mismatch, we are really concerned with asset to outside liabilities mismatch. We are not so much concerned with the, although that is a secondary concern, the liabilities to the shareholders. We are not so concerned with that. Mainly we are concerned with outside liabilities because that's where the risk is. Are you following the discussion? Yes? Okay. So asset liability mismatch is always a very important consideration in risk management. Okay. So ideally we don't want to see any asset liability mismatch. So what we are saying here is that the revenues of the company are in US dollars only. Alright, so this already cues you into to looking for any asset liability mismatch. So now that you have this information that the revenues of this company are only in US dollars, that means their assets are in US dollars. Okay, therefore if they have any non-US dollar liability, there will be a straight away you can see there's an asset liability mismatch. Okay, but that's not the end of the story in terms of risk on the liability side, because there's also going to be there is a dollar loan here which we have to which is, yeah, this dollar loan is not mentioned in the main. Okay, the US dollar loan has a rate index to 3-month LIBOR. Okay, so the other type of risk that you can have, this is an example of interest rate risk. Okay, so if we go back to this, you will see that there is an introduction of why have I made this company have only US dollar assets, because I want to create all these asset liability mismatches which you will now have to manage. Okay, so you will see here that there is actually commodity price risk, So we are covering all the asset classes. The only asset class we are not covering is equities, because equities, you already have a very good exposure to equities with cash equities on the NSE and US equity options. You have a pretty good exposure to equities. Now we are looking at the other asset classes. So commodities, then currencies. You have currency risk over here straight away, because your assets are in US dollars and you've got loans in yen and Aussie. So if there is any strengthening of the Aussie against the US dollar, is it good for them or bad for them? Bad for them, because if the Aussie strengthens against the US dollar, okay, then the dollar value of their liabilities will go up, because each Aussie is buying more US dollars. Okay, because your liabilities now, once you took a $2.5 million Aussie loan, the bank will want you to pay them back 2.5 million Aussie. Whatever happens to the Aussie FX rate, they are not concerned with that. So you will pay back only with US dollars. Okay, so therefore, if the Aussie strengthens against the US dollar, it will cost you more US dollars per unit of Aussie to repay. So therefore you are going to have losses. Okay, so therefore you are concerned with any strengthening of this. So this is a basic framework of asset liability mismatches. Okay, so all these elements will come into the discussion. So I'm just giving you a broad, yeah,
Commodity in this case is
here. Commodity price risk is coming here. We have not come to the discussion of that. I just told you that this is there. We'll see the discussion. We'll see the risk. Yeah, I'm just giving you a broad overview. Yeah.
What is this below 0.725 and 2.5?
1 minute. Where is it?
so below below the Japanese
Below the
amount.
This one. Okay. This one is yeah. This is just the this is just the input. Basically, I have made this instead of writing billions of dollars every time, I have just this is just my input thing. Like here I have made it in billions and this is in millions. Okay. So here I enter 2.5. Okay. So this is basically just for my convenience. Okay. All right. So is this framework clear? You're getting some flavor of what is involved. Okay. You have a balance sheet. Then we look at the conceptual framework. Yeah.
This AUD loan.
Yeah.
This amount is dollar loan. Everything displayed over here is dollar.
USD.
This is an Aussie amount. Okay, listen to this is an Aussie amount.
This is 250 Aussie.
Not 250, 2.5 million Aussie. Okay, 2.5 million Aussie. And what is this? There's so many comments I can't position.
This is dollar.
Okay. Now, this is the dollar equivalent. Okay, because it's a dollar balance sheet. This is a US based company. It's a US based company which prepares its financials in US dollars, and it only has US dollar revenues. So in any case, it will have to prepare financial in US dollars. Okay. So what we are concerned with, basically what's going to happen, we can see firsthand what will happen in the case of currency risk. Okay, now watch this, guys. See what will happen on the thing. So your net worth right now is slightly over 2 million. Okay. Now what happens to the net worth? Observe if what happens to the net worth and what happens to this figure. Okay. So right now the Aussie is 67.89. Okay. So if I can't even write with so many, so I'll have to basically move it this way. That is too complicated. Okay, we'll do that. I can do that. Okay, no, I think there's a shorter way to move it like a game console. Just move my up and down arrows. Okay, all right, guys. Now let's notice what happens. Okay, now on the left hand side of this, you have a 2.5 million is the Aussie amount of the loan. That doesn't change. Okay, but now I'm going to make the Aussie strengthen. So watch what happens to this the dollar amount here. Okay, watch what happens to the dollar amount. This will go up, and where will the adjustment come? Is my question clear? On the liability side, what is happening? The dollar, the Aussie loan, the dollar equivalent liability of the Aussie loan. Okay, not a very happy construction of sentences, but the dollar equivalent value of the Aussie loan on the liability side is going to go up. Okay, is total assets going up? Total assets is not going up, so total liabilities also can't go up. But what is happening is total liabilities will not go up, but one of the liability components, dollar amount, is going up. Okay, so what has to adjust? Net worth has to adjust. So this will go up and net worth will come down, and this will not change. So notice that. Okay, 6.7. Yes. So Khushbu, you can look up here magic. We are going to do some magic now. You can see what happens. Okay. So 6 point. Let's make it 0.69. Okay. Magic has happened, no? Yes. Is it happening? No change in total liabilities, but Aussie loan component of the liability has gone up, and adjustment, as Parul has correctly pointed out, has come in the net worth. Is the logic clear to everybody?
So how is it coming in net worth? How is the difference coming in net worth? Because the amount that we give to the shareholders, so it means that the share price is getting affected.
No, share price may or may not be affected.
So how come the net worth?
Net worth has nothing to do with share price. I mean, I shouldn't say nothing to do with, that's a very strong statement. But net worth relates to book value.
Actually, that includes
First understand this basic difference. Net worth is a book value concept. Okay? That is, it's related to the financial statements. And market price and share price is a market value concept. So you have to make this basic distinction between book value and market value. You have to understand the basic difference. So that's why I didn't want to make a blanket statement like it will not affect the share price. It may or may not affect the share price. We don't really know. Okay? Sometimes the share market reacts, sometimes it doesn't, so we can't really say. But the point is, what we can definitely say is, if you have a situation like this where the Aussie strengthens, okay, you have an Aussie loan with US dollar assets, you have an Aussie liability, okay, and the Aussie strengthens, okay, so you have a manifestation of currency risk. So what will happen is that because the Aussie amount of the loan remains the same, but per Aussie there is more US dollars now, the US dollar value of each Aussie is now higher, so therefore the total US dollar equivalent of this Aussie loan is now gone up. Yes. Now coming to answer, first let's answer Mehak's question, okay. Now what happens? Total assets has not gone up, right? So therefore total liabilities also can't go up. Yes, you agree? Now if total liabilities can't go up, but one of the liability components has been increased, then something else has to be decreased. So your question is only why should it be net worth? Okay, but conceptually think about what is net worth. Because see, think about this way. This is a loan, because that's why I said we have to be conscious of the high level split on the liabilities side, net worth and outside liabilities. The reason we use the word outside is because anybody who's not a shareholder, we consider them an outsider. Okay, let's say. Okay, that's why. Yeah, because the payments to shareholders are optional. Okay, they may not get any money at all. That's what they signed up for, right? Okay, so so that's why you have the high level split on the liability side as net worth and outside liabilities. So all these three are outside liabilities, and this is your net worth. Okay, so if one of the dollar amount of the Aussie loan has gone up. Now will the yen lender accept a reduction in the principal as a compensation? So one thing you know is that because the total assets is not changing, so total liabilities can't change. So some other component has to change. Okay, and the high level split is net worth and outside liabilities. So if you look at any component of outside liabilities, no lender is going to accept a reduction. The Japanese bank is not going to accept a reduction in their loan principal because your Aussie has strengthened against the US dollar. They are not bothered. Okay, the US bank is also not going to accept a reduction of US dollar principal. So outside liabilities cannot be touched. You cannot tinker with the principal repayment of the outside liabilities and the interest repayment also. You can't tinker with them unless you go in for a debt rescheduling and all that, which they are trying to do with many of these, distressed real estate companies and ILFS and all these people, right? Okay, which is Chug's area now, credit analysis, right? So all these rescheduling of payments and all these things, okay, that you do. That you will have to do, but that is not something that happens on a regular basis. Yes? Clear? Okay? Yeah.
Indian accounting standards, net worth is a part of liability.
Yeah, I'm not saying it's not a part of liability. You see, it is shown on the liability side. Because if you add this...
When we balance it out, there is a 2064,752 balance on asset side.
One minute. Just hold on one second. What is the total here? 4.7. Can you see? You can't see it. But if I add the outside liabilities If I add the outside liabilities, it comes to only 4.7. Okay, the total liabilities is 6.7. The balance is coming from this 2.064 of the net worth. Okay, so let's look at the high level understanding of the balance sheet, that for obviously assets has to equal liabilities, and on the liabilities side we are doing a high level split of net worth and outside liabilities. Outside liabilities, all kinds of debt. Okay, so because if the dollar equivalent of any debt has gone up in value, you cannot make any other component of outside liabilities take the hit, because no lender will accept a reduction in principal. Yes, clear? Everyone is clear? Yeah. So the hit will always be taken by net worth. Yes? Everyone follows? That is why shareholders exist. They are there. They are what kind? They are providing the risk capital. Bondholders are not providing risk capital. Shareholders are providing risk capital. Okay? That's why they stand at the end of the line. They are the last to eat. Okay, if Garvit has eaten all the pizzas, then shareholders cannot eat anything, right? So therefore, their income is optional. Okay, so therefore that's why we say net worth is a residual concept. If you remember when I did the Solomon case with you guys, then I explained this concept that net worth is a residual. You understand this term, residual?
Yes.
Net worth, yeah. Residue is what is left over at the end of the drink. Okay, when you drink coffee or tea, there's some little bit left over. That residue. Okay, so residual comes from the word residue. Net worth is a residual concept because it's left over, whatever is left over after deducting total outside liabilities from total assets. Okay, or let's say deducting outside liabilities from total assets. What is left over is net worth. So if the total value of your outside liabilities goes up, then net worth has to do the adjusting. Yes? Is this concept clear? Conceptually also now it's clear, because who eats the losses? The shareholders. They eat the losses. That's why there's a problem. You must have come across this term of shareholder theory, shareholder value versus stakeholder theory and all that. That companies should look after all the stakeholders instead of shareholders. The biggest problem with that theory is who eats the losses? Only the shareholders eat the losses. So they are special. They have to be treated as special people, because if you treat them as just like everybody else, okay, then they won't be the only. Then they'll say, why should only we eat the losses? Let the workers also eat the losses. Let the suppliers also eat the losses. Right? You're familiar with stakeholder theory? You know this? They have even said certain versions of stakeholder theory. They've said even terrorists are stakeholders. So you should have to run your company to satisfy terrorists. They have even said things like this, community development and all that. So then I'll say, if I have a loss, then let the community also share my loss. Will they share my loss? No. So the problem with this theory is that because the shareholder is the only one who eats the losses, so he has to be put above everybody else, because otherwise he will not agree to eat the losses. And so on the other side, what will happen? So let's revert this now. Is everyone clear about this? Whenever there's any loss, so you should basically, your conceptual understanding should be like this, that high level assets have to equal liabilities. On the liability side, you always have outside liabilities and net worth. Okay, and net worth is a residual concept. Is everyone clear about this now? Why net worth is residual? Whatever happens to total assets, total outside liabilities will not change. Okay, in the sense the local the original currency of the outside liability, this amount will not change, these amounts. Okay, so if there is any change in this, so if total assets minus outside liabilities, whatever is left over is your net worth. So in this case, what happened? The total assets did not change, but the outside liabilities amount went up. Okay, because the dollar amount of the Aussie loan went up and the others remained the same. The other two loan values remain the same, like this one remained the same, and this one remained the same. You can see my cursor moving. Yeah, these two remained the same, outside liability components, but this one went up. Yes, so total outside liabilities went up. Yes, but total liabilities did not go up. So net worth has to take the hit. The adjustment has to be to net worth, it has to go down. Okay, so this is basically what happens. You can think of a loss if you always, if you are doing an instantaneous balance sheet. Conceptually, if you think of a company doing a instantaneous balance sheet every moment. Okay, so whenever you take a loss, your net worth will go down. When you make a profit, your net worth will go up. If you buy all this stuff, now we can see later on, we'll do the exercises for this also, okay? But this basic concept is clear. The net worth has gone down. Net worth is a residual concept, okay? I'll just explain one side on the other side, one point on the other side, okay? Now let me, what did I, Control Z, no? Undo is Control Z. Okay, so now 67.89, now we'll make the Aussie depreciate and see the impact on net worth, okay? Now net worth should go up,
Yes.
okay? And this should go down. Dollar value of the Aussie liability will go down because the Aussie we are making it depreciate against the dollar, and net worth should go up. Total assets and liabilities will not change. Yes? Okay, so let's see that. Where, how much do you want to make it appreciate? Let's make it 65. Okay, can you see this? No change in outside total liabilities. Net worth, now you see what are the both sides. So net worth being a residual concept doesn't mean that they are only getting the short end of the stick. So they eat the losses and also enjoy the profits. So supernormal profits, okay, all these huge profits Apple is making, who is getting the real benefit of that? The shareholders, because they get unlimited profits, right? So now you can see why net worth is the residual. When the residue has increased, the shareholders get it. It goes to the net worth, okay? Because these guys will not accept a reduction in principal, but at the same time they can't demand an increase in principal when the times are good. Yes, everybody's clear? So we had a brushing up of the accounting concept. So I've taken 1 minute extra, but I'm very happy with the performance today because it was much more enjoyable teaching the class because there was not so much disturbance. Okay, good. Yes, you have a question. You guys can go if you can go. I'll record your question.
Sir, I just wanted to give an improvised answer.
Give a mic. Give him a mic. But whoever wants to go can go because the class is dismissed. Yeah, I don't want to retain you guys beyond the time. So just like we are forcing you to do everything in that break, but then at the same time we should give you a 15-minute break. Okay? Yeah.
Sir, an improvised answer to this question will be like you are saying net worth will change. So why net worth changes is because it has a concept of P&L, that is reserves and surplus included into net worth.
Yeah. You will close. It's like instant. You are closing the P&L into the balance sheet.
Yeah.
Continuously.
That's where net worth, because P&L goes into net worth.
Yeah.
So
that's what happens.
That's why it's increasing and decreasing.
Yeah. This is a good point. That's a good point. That's an expansion.
It's a bifurcation of share capital, P&L, and our reserves and surplus. So all three things, including P&L, will have an effect of this increasing and decreasing price, and then it will go into net worth.
Yeah, it is correct. So you actually in net worth we are including both reserves and surplus and share capital. Those are balance sheet entities, and P&L is a P&L concept.
And retained earnings will be affected due to this change.
Yeah. So we are talking just in terms of net worth, but you're right that it goes through the P&L.
Yeah.
Okay. So you close.
From an accounting perspective, it's coming from there.
Yeah.
In balance.
You are like, it's like we call it the closing. You're closing the P&L into. Imagine that you're closing the P&L into the balance sheet every moment.
We don't write P&L, but we include it into reserve and surplus. So instantaneously it's getting changed.
So you're doing it that way. Yeah, it is correct. It's coming through that. No. So if you have a P&L, if you have a loss means what? You have a debit balance. Loss means loss means you have a debit balance on the P&L. So what will you do? How will you close the P&L into the balance sheet? You credit the P&L and debit the net worth. I'm just calling it net worth because it's a catch-all term. It's a catch-all term. It includes your reserves and surplus, everything. Okay, paid up share capital, everything is. I just use the word net worth to capture everything. Okay, all the money that belongs to shareholders.
Yes.
Okay, so you close that P&L, you credit that P&L debit balance, and you debit the net worth. Okay, that's how it gets
So, where you were changing the price, this is 0.65 per dollar. Aussie per dollar.
Yeah, if you see now, if you look at the Aussie chart, okay, if we close. Okay, if you look at this, how is the Aussie quoted? How is the Aussie quoted? What is the base asset? In Aussie, when you are trading spot Aussie, what is the base asset? Aussie. Terms asset is US. So spot Aussie and Aussie futures both are traded in the same way, with Aussie as the base asset.
Yeah.
Okay, so here 0.68, you can see the figure here also. 0.6831 means each Aussie buys 68 US cents, 68.31 US cents. Yeah, this is yeah. So dollar is the US dollar is the terms asset. Okay, so this means that each one Australian dollar buys 68.31 US cents, or you can say 0.6831 US dollars. Yes, because 100 cents is equal to $1.
When you change this 0.67 to 69, at that time Aussie depreciated.
No,
It appreciated.
remember the rules that I've taught you, and all the rules are backed up by logic. When we studied charts, what did we say? When we studied in any market, see, a chart will be for any market. Understand this clearly now. Okay, the chart will be for any market. So this kind of thinking, once your concepts are clear, you can do it like that. Okay, that for any market you have a chart. You should know immediately what the base asset is. Chart going down means base asset is depreciating. Chart going up means base asset is appreciating. Okay, so in this case, when the Aussie is the base asset, okay, so if it is going up, that means it's appreciating. And if the chart is going up, and chart is going up means values are increasing, because this is a normal scale, not an inverted scale.
This means base asset is appreciating.
Because normally we draw charts with a normal scale, not an inverted scale, which means lower numbers are lower and these are magnitude of these higher numbers are higher on top, right? Normal scale, right? You're going from low to high. So in a normal scale chart, then what will happen whenever the chart is going up means the base asset is appreciating.
And we have to pay more dollars.
Yeah, in general terms, you have to pay more of the terms asset per unit of the base asset. Okay, so this was already discussed when we were discussing charts. Remember, you have to refresh that. So all these basic foundations are already laid before, so that you can understand. So once you understand this concept, then because in real life you can't afford to, when you're looking at a chart, you can't afford to go back and think through the logic. You should be clear about the logic, but you should have done it so many times that instantly you'll know that when the chart is going up means base asset is appreciating. Yes, this is clear. So when we increase this, we made this, you switched it off. Okay, so where was the, and I have to go Control Z again. No, I want to go back to the original values. So now I've gone back to 67.89. Okay, I wrote it down, I made it depreciate to 65. Okay, now we are back to 67.89. Okay, this is clear. Okay, you're finding this interesting?
Yes, sir.
Okay, good.
So in project you have to manage this.
Yeah, you will have to manage this balance sheet.
Tomorrow.
Yeah. Tomorrow it will take many sessions because many concepts have to be cleared up. No, because these are. I'll put this notes into your notes so that you have to read.
We have to hedge.
You have to run a hedge book.
Okay. So
Now-
this shouldn't change.
Yeah. Now, no, it will change. Basically, you will have to run a hedge P&L.
Yeah,
See,
so
basically,
we
what will
hedge.
happen is, 1 minute. I'll explain later on. But the point is, basically, what you'll have to run is, you'll have to understand the exposures first. You have to understand which side you are exposed on.
Okay.
Here the concept, now one of the decision problems will change when we see. We have done the decision problems earlier. Earlier we used to decide whether to buy or sell. In this case what you'll see is whether to buy or sell, that decision problem is automatically solved. Because now you're working with a hedger's balance sheet.
Yeah, that is done.
What is the underlying position here? You have to understand what is the underlying position.
Underlying position in Aussie dollar is.
What are
Aussie
you?
we are long, no.
No, you're short Aussie.
You are short Aussie.
You have to understand that because of this, like in this example, you have to understand the underlying position. Okay, so we'll have all these discussions. We have borrowed Aussie, so we are actually short
We are
Aussie.
short Aussie.
So we'll basically we'll give you the rule. I'll give you the logic for figuring out how to figure out whether you're long or short in the underlying position. Okay, so in this case you're short Aussie.
This is short.
Yeah, the assets are long. Okay, these are short. Okay, but here in the case of the market, you'll have to understand here actually you're long dollar yen.
Yeah, we are.
You're long dollar yen, you're short yen actually. Long dollar yen, here also you're short
We are
yen.
short yen.
You're short yen, okay? And this, of course, this is the floating rate, this is the index.
So we are-
You are short, it's like you're short LIBOR.
This is our loan, no?
This is a dollar loan, so there's no currency risk, but there's interest rate risk because it's a floating rate loan.
Yeah.
So you're short
Cost.
LIBOR.
Cost of the
Okay, so you're short LIBOR because it's a floating rate loan. So all these things, so you'll have the exposures now, you'll have to manage. Now what, so because you're already short, So the question of buy or sell has already been solved. You can only buy now.
You have to counter that through futures.
Yes, you'll have to run a separate like 2 floors of an airport. Okay, arrival and departure.
Yeah.
Now the arrival has already been fixed.
Yeah. And
Now on the departure, you're playing around with the departure. If Pulkit is walking around here, the arrival, you have to shadow him.
Yeah.
Okay, you actually have to shadow him on the other
that
side.
future will do automatically.
So whatever you're losing on the arrival side,
And
you have to
futures
make
will-
up on the departure side.
That
Yeah.
future will do now. We just have
You
to
have to
decide
do
the
it that way.
position.
You have to take the position
We
accordingly.
have to take position.
So you have to again, eventually what will happen is, at bottom line, go back to the same old problem, you have to take a view on the markets.
Okay.
That means if you
That also
buy,
you are giving us.
that is what you have to do. That's your job.
No, but you have given us an amount of 2 million.
1 million.
1 million.
Account has only 1 million.
Yeah, 1 million.
So you will have to basically decide what is the right time. Is the Aussie going to appreciate now? Because if you buy it now and it actually depreciates, that means in retrospect you should not have bought it. Because you're only concerned, you're short Aussie, so you're only concerned if the Aussie goes up. But if you think the Aussie is actually going down, you should not be hedging. So you have to time the hedge.
Okay.
So your buy-sell problem has been solved. Whether to buy or to sell is automatically solved, but whether to, at what price, whether to enter at market or to enter at using a limit order or a stop order, that problem will remain. So these are the nuances that you will see, how the decision problems change in a hedging context. Is this clear?
So these are the figures. These were the figures for the project.
Yes, these are basically the figures. These are the actual figures.
This is what we have to work upon.
Yeah, and the actual market prices I will freeze when the project starts. But these are the figures. But the figures don't matter because the logic is the
For
same.
position size we have.
Position size, but what you're practicing really is not so much the size. You are practicing really is the question is you are looking at this. You know that your balance sheet is short Aussie. What you're really doing is what the training that is actually happening through this project is you have a balance sheet which is short Aussie. Now you're looking at the Aussie chart or looking at the Aussie fundamentals and taking a view, is the Aussie likely to appreciate? If the Aussie is likely to appreciate, then you better hedge everything right now.
Right now.
Okay, so everything is down to market timing. What you're practicing is market timing. So whether you're doing one contract or 10 million contracts, it makes no difference. In your project, it makes a difference. But in terms of your learning and conceptual clarity, it makes no difference. In terms of the logic that you're learning, it makes no difference. Position size, if you're working for, let's say, ExxonMobil in Houston, okay, selling 10,000 oil contracts at a time, the logic will not change. Obviously your account is much bigger, so you're just scaling up the size of the positions, but the thinking does not change. What we are teaching you in the MBA program is the thinking process, right? So the logic will not, so the theory will not change, right?
So
Okay.
I have a question.
Yeah.
Like you said that the main components in the liability side will be net worth and other liabilities.
1 minute. So finally Mehak has become interested. Well, normally she's looking at her WhatsApp, but today she has a question. Yes.
So
Yeah.
net worth and other liabilities.
Yes.
So in the Indian
The high level,
balance sheet-
no, not other. The term that we should use is outside liabilities.
outside liabilities.
Okay, because these are liabilities to outside means we are using the word outside to refer to people who are not the equity shareholders of the company or common shareholders of the company.
So when we look at the Indian balance sheet as well, these are the main heads that.
Yeah, see, in India we don't use this kind of terminology, but conceptually this is the terminology you should have in your head. Okay, we may use all kinds, like I'm using net worth. So here net worth would include reserves and surplus, paid up share capital, all these things. But all of this we are capturing conceptually through net worth.
And the non-current liabilities and the current liabilities that would come under.
That is covered under C. Some of this basically here I have only shown non-current effectively. You can think of it as, because we want to teach you how to manage long-term loan risk. Okay, so these are all non-current liabilities. You can think of it this way, because these are not short-term liabilities. Okay, so these are all non-current liabilities. These are all in the nature of long-term loans, because we want to use these examples to teach you loan risk management on long-term
So you are
loans.
taking the balance sheet that you said.
That is
You use the
stylized.
stylized.
It's a stylized balance sheet. So I have taken only certain types. I have not shown you everything that normally appears on a balance sheet.
Yeah, this is around capital line. Yeah, but it's like abstract balance sheet.
Yeah, it's an abstraction. Okay, like a model is an abstraction of reality. So I've done an abstraction of a balance sheet. It's a stylized balance sheet where I have taken only certain types of items which appear normally on a balance sheet. I'm not showing you fixed assets. I'm not showing you current liabilities. I'm not showing you any other current asset other than inventories. No accounts receivable, no cash, nothing is being shown. Okay, because I have all kinds of constraints, because I have to remember the $1 million size, and then I have to look at the contract size on CME. So the numbers don't matter so much. The theory that we will learn through these numbers is exactly the same that you will apply even if you make this into a multi-billion-dollar balance sheet, like a big commodity company like Rio Tinto or ExxonMobil, multi-billion-dollar exposures. The logic and the theory will remain exactly the same. It's your numbers will become much bigger, but that doesn't change anything in terms of substance.
So what we said for the bond YTR and IRR, can we extend the same reason for the bond YTC?
1 minute. YTC is yield to call.
Actually,
Yeah, same concept. Basically, yield to call, what is happening is your maturity date is just being arbitrarily shifted by the issuer calling the bond. Okay, so you can't really predict when, unless there's a fixed provision for that, but normally it is just option that the issuer has. Okay, so in the case of yield to call, what is happening is the answer to your question is that it's the same. Mathematically, there's still no difference. Okay, so yield to call is not an expression that we use normally. First, the more commonly used expression is, normally we discuss in terms of YTM, but yield to call is basically just that the issuer is artificially shortening the maturity of the bond by exercising his call option. Okay, so it's the same concept. The same terms will appear. In this case, the payment of principal will happen at an earlier date than what you thought would actually happen earlier. Is this clear? Okay, good. So Mehak should maintain this level of interest. The next class is no more WhatsApp. Yeah, okay. All right, thanks.